Hello guys, this is FX Bright, the trade guru. So look, on this video, I'm gonna be teaching you guys a lot. Right? This video is gonna be one of those videos you watch, and it will change your trading forever. It will be one of those videos you're gonna recall that I watched so video, and this video turned my trading for the best. So listen guys, I'm going to be teaching you guys something really important, so please like and subscribe and turn on the bell notification. Guys, we're going to be taking off on this channel. And listen, if you want a one-on-one mentorship, I do offer that, so let me know. And I'm going to be teaching you exactly step by step on how I take my trades and make good profit on this market. So listen, on this particular I want to show you guys something. So let me get to this point. Now listen. What the market does is that the market, let's assume for instance a double bottom. What the market does is that the market goes down, it comes up, it goes down, and at this particular leg is where everybody takes a buy. So now this brings me to the definition of what exactly is liquidity. Liquidity is that point in the market where a lot of orders are filled in, right? So a liquidity zone is that point where lots of orders are filled in. So let's assume this particular W structure, for instance. So the market comes up, it goes down, and it comes down again. So at this particular point is where most people are interested. So they try to buy the market at this point. So you're not the only one that knows about that point. A lot of people knows about that point. So this particular point becomes a liquidity zone because a lot of buyers have come here to fill in their buy orders. So there's a lot of buy pressure on this point for the market to blast up. So this particular zone becomes a liquidity zone. And for those other people that like to trade the double bottom a little bit differently, some like to trade it like this, it goes up, and guys, go to my video. I do have a very good explanation of how to trade a double bottom and double tops. You're going to listen, that video you can't lose. You cannot lose trading that way. Listen guys, so go to that video and learn how to trade the double tops and double bottom and come back. And okay, so some other people, they like to trade it on the break of neckline, right? So what they wait for is after the market comes down, does this, and it's now going up again. They let it break and comes down for a retest, and now they take the buy at this point to let the market go up. Now, this particular zone, you're not the only one that knows about that zone. A lot of people knows about that zone. So that particular zone becomes a liquidity zone because a lot of orders will be filled in around this point. So this particular point is a liquidity zone. Now, if you've traded the market for any length of time, you're going to experience what you call the liquidity sweep, which is done by the big players in the market, right? So the big players of these markets. So what they try to do is, let me use the same double bottom for instance. The market comes down, it goes up, comes down again, and is about to go up. So there's a lot of people that have placed in their buy orders at that point. So what the big players come to do is that they know that most of the retailers are in this particular zone buying the market. So what they do is that they come with a lot of selling pressure to try to push the market down, right? So you that bought the market at this zone, your stop loss is somewhere below here. So what they do is that they push the market below to hit your stop loss, right? So if you're buying, that means your stop loss is a sell order. So you start selling your market to them at low price, right? So that's them hitting your stop loss is you selling. So you're selling at lower price. So they begin to, buy they begin to buy all the goods you're selling to them, right? So this is how I'm saying. So you're trying to buy, and it infuses to a lot of sell pressure. So your stop loss was somewhere here. Your stop loss is obviously hit, right? So you have sold to them, and every other person that has their stop loss around this place sells to them. So once they get the get all the liquidity, which is all the orders, they now, you're selling to them. That means they are buying. So they now buy, right? And now what you will see in the market is that the market just swings up like that. So you will now be in a kind of regret that, oh my days, you were entering the market here for a buy. All of a sudden the market still came down and still gave the same buy you were expecting. So this is what they do in the market. They try to sort of manipulate it. So today I'm going to be teaching you guys how to trade the market and how to even sort of dodge these type of liquidity sweeps. So using it in the inverse direction, which is like the M structure. So what the market does again. Now listen, guys, I'm just using the simplest pattern, which are M's and W's, and to relay this explanation. And obviously there are different places where people place buys. Some people use moving averages, some type of moving averages to find the place they can place a buy or sell orders. Remember, a lot of people are also looking at that spot. So that particular zone becomes a liquidity zone and is subject to manipulation when the time comes. So you have to be able to know how to, be on the right side of this type of market. So now the market goes up, it comes down, goes up again, and now the market is on its way down. So the big players come and puts some buy pressure here. Remember, the retailers are out here trying to sell the double top. So the big guys come and put a lot of buy pressure on this particular leg. So what you notice is that they have a lot of money. So their money is bigger than your money. So the market will move in the direction of their money. So since they are buying, the market starts going up. Remember, you are selling. So your stop loss will be a buy order. So what they do is that they infuse a lot of buy pressure here. So it's going to hit your stop loss. That means you will buy from them at higher prices. So once they've been able to hit everybody's stop loss, that means everybody has bought from them at higher prices. They now bring down the market with great speed. So that's when you see the market just moves and you're wondering, oh my days, you know what I'm saying? So guys, how do you trade this type of market? Now listen, in any trading formula, there's what you call the conditions. The entry, the stops, and the target. Now, like this particular thing is what will save you from different types of errors, right? Your conditions, your entries, your stops, and your target. Now, listen, guys, I have a way I trade my market with precision. Now, I told you if you want a one-on-one class, we can always have that. But listen, I'm going to be teaching you guys a lot on this channel, and you probably will learn. You will learn a lot just by listening to this channel. So, like, I'm going to go to the chat so I can show you some things. Now, let's assume, for instance, this is the market. So you can see what the market is doing. The market is coming all the way down, right? It came down. So you can see what looks like a W pattern. Like if you look at it, you can see what happens like a W pattern. So what the market was able to do. Now these are no chart, but I just want you guys to understand the thinking process behind how this market makes its move. So you can see the market came down, came up, came down, and now you can see the market is breaking this resistance area. So I'm just going to put this line here. I'm just going to put this line here to try to map out the area. So you can see how the market have its neckline here, and the market came around and whatever, and the market broke it and came down for a retest, and now the market is going up. So there's tendency for you to place your buy orders on this particular leg. Now, depending on the strategy you're using to enter this market, you can, maybe if you're using a 1 minute time frame for your entry, you can find these things I'm talking about and probably have an exit somewhere around the top of this place. But let's say this is your entry area. Now you're buying this market, so you're probably trying to go up with this market. So in most cases, what some people do is that once they buy, this is the zone area, so they try to put their stop loss somewhere below here, just somewhere around below. Obviously, that is not really a bad way to trade, but you have to now understand the next thing I want to tell you. So now let's just scroll through and see how the market reacted to that zone. So you can see the market actually got to the point, bought a little, and now went up and came down. Now, what some people would definitely think is that this is like a triple bottom or whatever, right? So probably formed like hitting this place twice, so this place has to be stronger. So maybe they won't add more positions, putting their SL below this point, trying to, be happy and go up with the market. But you can see what probably just happened in about a bit. What the market did is that the market just, did all this and came down and broke it. So if their stop losses were somewhere around here, it will hit all the stop losses and comes down, and you can see how the market came down and did the exact move that was in their mind. So what they were thinking is that the market would have bought, when they were here and moved up. So now, especially for the retail traders with small accounts, there's a tendency for you to try to there's a tendency for you to try to be very, very very, very, with very, very, what's the word? Cautious with your account. So you try to put your stop loss as close as possible. So now, maybe that's not a bad thing, but if you don't understand this very concept, you'll probably lose your money on this particular move before the market makes the buy that you were hoping the market will make initially. So now the market goes up. Now the market makes that moves and goes up, and you can see how the market was able to just hit the TPs that you would have probably projected for the market to hit initially. You would probably be very much angry. And you see, one of the issues with retail, with especially traders with low accounts, is once the market makes this type of move and hits you out of the market, you become emotional and do a lot of things on top of this place, violating even the principles that you're not supposed to. So what people do again is, so at this particular point, you can see this place is a good resistance zone, right? So you probably expect market to drop into it, like make a bounce of it, and you can find a good entry. So you can see how the market came all the way to that point. So what it's doing. So you can see how the market has been able to form what another person would probably call like a double bottom, right? Coming up and is about to also probably buy. So you can see some people will probably have put their buy pressure on this particular leg. So what's probably happens is this again. So once you buy at this particular point, you're going to put your SL somewhere below here. So what the market does is sweeps up all your stop loss, which at this point will be a sell orders. So it sweeps all the stuff. So what this means is that you're selling to them. So if you're in a buy position, your stop loss is a sell order. So when the market comes down, it's hitting your sell order. That means you're now selling to them. Whatever you bought here, you're now selling to them at low prices. So it takes up all these everybody that has their SL on this point. So you're selling to them at low prices. So whoever sold here, whoever had his SL all the way down to this point has sold at a very, very low price. So what you see the market does after it has finished taking everybody's liquidity. So this is called liquidity sweep, because at this point you have a lot of SL. So it sweeps up this liquidity, and the next thing you see is the market start going in the same direction that you thought it wouldn't. So even this happens. So if you're able to kind of spot this particular point, you'll be able to take these buys and spot the liquidity. Now, how do you do this? Now, there are different ways to escape the liquidity, but I'm just going to show you one in this particular video, and I'm still going to make more videos in the future. So one of the ways to understand how to escape liquidity is through your entry orders, your entry reasons. What reason do you want? Your entry reason. What reason what about the market happens for you to enter? And one of the ways I tell you guys to enter the market is using your trend lines. If you notice my videos, I use a lot of trend lines, and there's a way to use trend lines. And if you do use trend lines the way you're supposed to use trend lines, you will almost always be perfect. Now, listen, there are some times you might still get the liquidity, but it will not be as much as you're experiencing it right now. You will be a very, very profitable trader. Now, what I'm saying is this. Now, I'm going to teach you this secret. What happens is that when you look at price on this particular entry, any place you're using to enter the market, what you want price to do for a zone like this, what you want price to do is that you want price to move in a trend. Anytime you see price not moving in a trend, you have to be very suspicious. What I'm saying is this. If you come to this particular point, what is a trend? A trend is when price is having this zigzag move, right? So let's assume this is an uptrend. and the price is going up, it's coming down, it's going up, it's coming down. What I mean by trend is that as the price goes up, as it's coming down, you want it to come down in a trend. You don't want it to just drop down straight, right? If it drops down straight in your entry entry time frame, you probably want to be suspicious about liquidity sweeps, because what is most likely going to happen is that when price goes up, comes down, goes up again, and it just comes down straight. It doesn't give you the zigzag. Now it can do it straight in the analysis time frame. Maybe if you're analyzing from a 1 hour or 2 hours or 4 hours time frame. But if you're going to go down to your 15 minutes time frame, you want to see the price giving you this kind of pattern so that you can be able to understand the trend. The price has to break this particular trend for you to know it's going to go up. So if it doesn't break this trend, you can't know it's going to go up. Now, not to talk of when it just comes down straight without a trend. So what I'm saying is this: when you come down to this particular place, what you're going to see is that the price drop down. There is no particular trend that the market used in going down. So because of that, you cannot trade these. You would be wrong to just come here and place a buy and trade it. If this is your entry, if this is the place you're making the entry, understand me, if this is the place you're making that entry, you can't just come here and take a buy. So what you will probably do is wait for price to give you a trend. And the only place price gives you a trend, you see what price did here. Price came down, went up, came down and broke. So this is a trend. This is a 1, 2, 3. So the moment price is able to do something like that, what you probably want to do is you will now have the legal right to use the trend line to join that trend. So when price did this, right, and broke down, so once you put your trend line on that point, any day price is able to break this trend line, this is the time to take your buy. So you can see, if you were waiting for something like this, remember in this particular one, there was no way to draw that line. But now when you saw this and the price came down and gave you this one, you're able to draw that line. Any day price breaks this line, this is the time to take your buy. So you will not be amongst these people that bought somewhere around this point and liquidity came and caught them here. If you were in this particular also place, you can see how now I'm taking this as the entry pattern, the entry time frame, right? So once the price comes down like this, you can see that there was no trend. There was no trend pattern. There was no zigzag pattern here. Price just dropped down. You can't take a buy on this type of this thing. What you want to wait for is for price to give something like this, give a trend before you take that buy. So if you were going to wait for that, what you would have seen is something like this. So now this is now the trend that you will probably wait for. So once you draw that line, you will now know that this is the time to buy. So you will never have bought at this particular point because you see this support zone and price is buying. What you wait for is for price to break this trend, and the moment price break this trend, this is where you take your buy from to wherever it is. So how I like to take it usually, I told you once I take this type of buys, I take it all the way to the 88.8 Fibonacci, and life is good. So guys, this is one way to understand how you can go and do your back test and see how this works, guys. So now another way, which I think I'll have to do a video on that one, another video on that one. But guys, I hope you learned a lot on this particular video. And like I said, please like and subscribe. And if you do want a one-on-one mentorship, I'm open to that. So please contact me, and I'll see you guys in my next video.